Red flags in investor and entity transactions. You are not law enforcement, but you are a licensed professional. Arizona real estate agents are not federal investigators. You are not required to conduct anti-money laundering audits or perform financial background checks. However, under AAC R428-1101, licensees must exercise reasonable skill and care and avoid conduct demonstrating incompetence or untrustworthiness. That means you cannot ignore obvious irregularities in a transaction. Awareness is not accusation, it is professionalism. The 2026 reporting rule exists because certain transaction patterns historically presented elevated financial risk. Recognizing red flags protects your brokerage, your license, your client, and the transaction itself. One common red flag involves unusual urgency combined with entity structure. Arizona regularly sees fast investor closings, particularly in flip markets or competitive short-term rental zones. Speed alone is not suspicious. However, if an LLC buyer demands an extremely rapid closing, resists providing entity documentation, refuses to disclose ownership information, and becomes agitated when federal reporting is mentioned, that combination is concerning. The appropriate professional response is procedural and calm. You may state that escrow will coordinate required documentation before closing and that all compliance requirements must be satisfied. Neutrality protects you. Another red flag may involve complex, layered ownership with no clear business purpose. Arizona investors frequently use multiple LLCs for liability separation, and that structure is legitimate when used properly. However, concern may arise if multiple entities are formed days before closing. Ownership is transferred repeatedly before funding. No clear operating agreement exists, or no one can explain who actually controls the entity. You are not required to investigate ownership chains, but you should escalate concerns to your designated broker and coordinate closely with escrow. Lack of clarity combined with transaction pressure is different from sophisticated structuring with organized documentation. Payment sources that do not match the transaction structure may also raise concerns. For example, funds wired from an unrelated third party with no documented connection to the purchasing entity. Offshore accounts that do not align with the entity's stated business purpose, cryptocurrency transfers lacking documentation, or hard money. Lenders with no identifiable corporate presence may warrant heightened awareness. Arizona agents are not responsible for verifying bank compliance, but obvious inconsistencies should not be ignored. Escrow handles verification. Your responsibility is communication and awareness. Contract assignments are common in Arizona wholesale markets. Assignment alone is not a red flag. However, repeated last-minute changes such as an individual contracting and assigning to an LLC days before closing, ownership percentages being adjusted shortly before funding, or a chain of transfers from one entity to another with no clear business explanation may suggest attempts to manipulate reporting thresholds. Agents must not participate in restructuring discussions or offer strategic suggestions. Legal questions should be referred out. Direct client statements can also signal elevated risk. If a client explicitly states that they do not want the government to know about the transaction, that they must keep ownership anonymous, or asks how to avoid federal reporting, that is a serious warning sign. The correct response remains procedural. Reporting requirements are federal law, and escrow will determine what is required. Do not debate policy. Do not express personal opinions. Do not offer structuring advice. It is important to distinguish between sophistication and suspicion. Arizona has many experienced investors who operate through layered entities, private funding, and portfolio strategies. Complex structure does not equal wrongdoing. The difference lies in intent and behavior. Normal investor behavior includes organized documentation, clear ownership explanation, cooperation with escrow, and professional communication. High-risk behavior often includes secrecy, inconsistency, resistance to documentation, and attempts to manipulate ownership percentages to fall below reporting thresholds. Professionalism means recognizing the difference without becoming accusatory. Brokerages should establish clear escalation protocols. If an agent identifies unusual entity or financing behavior, the agent should notify the designated broker, document communication, coordinate with escrow, and avoid independent structuring advice. Reasonable supervision under AAC R4 28-1103 includes providing escalation channels and ensuring agents know when to seek broker guidance. Documentation protects everyone involved. There are also clear boundaries agents must never cross. You must never conduct independent investigations, accuse clients of criminal conduct without evidence, refuse lawful clients arbitrarily, attempt to interpret federal criminal statutes, or suggest creative ownership restructuring to avoid reporting. Your role is facilitation within compliance boundaries. Arizona's investor markets in Phoenix, Scottsdale, Mesa, Paradise Valley, and surrounding areas will continue to thrive. The 2026 rule does not eliminate investors. It increases transparency. Professional agents adapt by understanding risk indicators, maintaining neutrality, and coordinating appropriately. Now that we understand how to recognize red flags, the next step is proactive strategy. Section 5.3 will focus on structuring investor consultations in a way that reduces friction before reporting issues arise. Preparation replaces reaction,